You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, Characteristics and Risks of Standardized Options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Good afternoon, ladies and gentlemen. We're going to get started. Thank you for attending the Option Industry Council's webinar series. My name is Nick Ziegler, and I'm a staff member here at the OIC. I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. And now, ladies and gentlemen, Joe Burgoyne will introduce our panelists for today's topic, Options and Income Strategies, What You Need to Know. Joe?
Hey, Nick, thanks so much. And as always, thanks to everybody for joining us. We got another great panel this month. And, our topic, income strategies, what you need to know, is, I think, really relevant. So we've got, as Nick said, Laurie Itkin joining us. Some of you may know Laurie as the options lady, as Nick mentioned. Laurie's also a financial advisor for Coastwise Capital Group. Dr. Alan Ellman, founder of the Blue Collar Investor and author of 6 books, is joining the group today, as is our own Ed Modla, head of investor services at the OCC. I think actually I want to give each of our panelists an opportunity to tell you a little bit about themselves. So, Laurie, how about if you go first?
Sure. Thanks, Joe. Happy to be here. Welcome, everyone who joined, and a special welcome for the folks that get my newsletter and have joined through that. As Joe said, my name is Laurie Itkin, and I'm a financial advisor and author, and I specialize in income-generating option strategies. So, of course, it makes sense I'd be on today's panel. Let me just tell you briefly. So I am a financial advisor and money manager in Southern California. I do have clients around the country, and what I think is interesting is that all my clients who've had financial advisors in the past, I'm the first financial advisor they've worked with who actually uses options. And there's a good reason for that, because I have to stay competitive in terms of fees with other money managers, and it's a lot easier and less time-consuming for a financial advisor to put clients in cookie-cutter mutual fund or ETF portfolios where I really have to work because options is a fairly active activity. What I do for people who don't have enough assets to work with me where I'm managing their money, I do have investment education packages where I teach people through using Skype and screen sharing how to do write covered calls and write put options in their own account. So I feel I can help everybody that way. And then I also have a book called Every Woman Should Know Her Options, Invest Your Way to Financial Empowerment. I can be reached at theoptionslady.com. And I'm thrilled that Alan Ellman's on the call with us, because I have to say he has phenomenal books on the subject of covered calls, gives a great presentation, has a great website, and if you are a do-it-yourselfer, you really can get everything you need through learning his processes.
Thanks, Laurie. That's a heck of a segue. Alan, how about if you tell our listeners about yourself for those of you who don't know you?
Thanks, Joe, and thanks, Laurie, for those very kind words. The Blue Collar Investor is an educational and stock screening service geared to retail investors, and specifically for the strategies of covered call writing and selling cash-secured puts. As Joe said, I've published 6 books, 5 of them on the topic of option selling. My 6th book is a general investment guide geared to students or anybody not near retirement, and that book is required reading at the University of Maryland, both for its honors finance program and for its freshman class, and used in many schools throughout the country. I've also produced over 300 videos and journal articles on topics related to option selling, as well as producing 3 DVD programs. I've been very fortunate to get invited to venues all over the United States, so every month I'm in a different city lecturing on this topic of option selling. I do hold a Series 65 investor advisor rep, but I choose not to manage other people's money, but rather to focus in on the education for retail investors and teach them how to generate cash flow using these great option selling strategies. Joe, thanks again for the invitation, and thanks to everybody for attending this panel discussion today.
It's our pleasure, Alan, and having you and Laurie, who both specialize in the income generation strategy, is just fantastic. And we round out the panel with one of our own. It's always great to have a colleague join. And Ed Modla, head of investor services at OCC. Why don't you tell the folks a little bit about yourself, Ed, before we get started?
Sure, will do. It's great to be here, and thanks for everyone for attending here today. As Joe said, I manage the investor services team at the Options Clearing Corporation. What that means is all day long we're taking calls from industry professionals. Those could be financial advisors or trading firms, exchange staff, data personnel, asking us all sorts of questions about anything options related. So we are sometimes referred to as the options experts team here. That's what we do during the day, and this comes on the tail end of having a career in the trading business. I started out on the trading floor in Chicago at CBOE, moved into New York a little bit on the trading floor, and then, of course, moved to the screens. So went from the pits to the screens for a number of years, and now in the service side of the business. In addition to my day job with OCC, I'm also instructing for OIC, so that includes webinar events such as the one today and live events at OIC-sponsored seminars and some industry-related events as well.
Dynamite, Ed. Let's see, just a couple things that I guess housekeeping. I think people who are using options are aware of the guide that the industry puts out, Characteristics and Risks of Standardized Options. If you haven't used options before, you should reach out to your broker or the OCC for that guide that speaks about the risks and benefits of the exchange-listed product. Also, and I think Nick may have briefly mentioned, we do have a survey with 6 or 7 questions. I would really ask you to try to take, a minute or two at the end just to fill it out, and kind of gets into a little bit about who we are. The OIC was founded in 1992, so we have been funding education since that period to both retail clients, retail investors, and professionals since '92. We are funded by a combination of the Clearing Corporation, which is the OCC, as well as the 7 parent option companies. We do now have 14 option exchanges in the U.S., 7 parent companies. For those of you who might be listening to an OIC webinar for the first time, you've never heard me talk about how much I love this slide. Lower bottom left-hand corner is 1973 when the industry started. The industry started in Chicago then. There were 16 companies that had options listed on them. Calls only, no puts until 1977. The SEC didn't allow them, if you can imagine. And you can see over the course of these years, and those numbers on the left side correspond to hundreds of millions or billions of contracts. You can see we went from 73 to almost 2,000, trading somewhere in the neighborhood of under 500 million contracts. And at that point, the ISE was founded, the first electronic exchange. It gave investors the capacity to access the options market electronically, which I think had a huge impact on potential volume and business going forward. And as you can see, there were other factors as well. But now we've got over 4,200 products listed on the 14 various exchanges, combination of individual equities, ETFs, and indexes. And, when we talk about 4 billion, 4.2, 4.3 billion contracts a year, that breaks down to almost 17 million contracts a day. So it's a little bit about the history of the business. Let's bring our panel in. We're obviously going to be talking about the whole covered call income generation aspect today. We'll do that in conjunction with selling puts as well. And I think if we have time at the very end, I may call on Ed Modla to talk a little bit about credit spreads. So I think maybe at the start, Ed, why don't I reach out to you to maybe define covered calls and maybe speak briefly about the benefits and risks.
Sure. So we'll lay the foundation here from an educational perspective. Just like most any other options trade, the covered call starts with your market outlook. The beautiful thing about options, why they're so popular with investors, is because whether your outlook is bullish, bearish, or neutral, there's an options trade that fits the narrative. So for the covered call specifically, what you're really looking for is a neutral to slightly or moderately bullish outlook. And the construction of the trade would be owning stock, being long shares of stock, and selling a call option. So you can do that either simultaneously or you can do that separately. But the two components are owning shares of stock and shorting a call option. The benefits here, as you see on the screen, certainly the primary goal is to increase returns. Your main objective here is to increase your return by the amount of the premium you receive from the call option. Compared with, say, just owning stock outright, if you were in a neutral environment or a consolidating environment and you own shares of stock, you certainly wouldn't see much return in your account, if any. But if you had sold a call option and received that premium, then in a neutral environment with the stock consolidating, of course that option premium will increase the return in your account. And over again, using this strategy successfully over the course of a year, you can really see a nice bump in your account returns for your portfolio. So there's your primary goal of what you're looking for with the covered call. Of course, that's not it. The other goal is that it limits your downside risk, specifically by lowering the break-even point. Again, if you look at the straight stock trade, if you buy shares of stock, you are at risk of losing as soon as the stock moves lower. You see on the graph here, as soon as you reach a point where the stock moves below your entry point, the position starts to incur losses. But if you've sold a call option as well, then the premium received from the call acts as somewhat of a buffer and lowers your break-even point. In other words, the stock would have to move lower by the amount of option premium you received in order to reach your break-even point. So this accomplishes a couple of things for you. First of all, it gives you that extra premium and gives you that income, but also it gives you more opportunities to be successful, or a greater likelihood at being successful on the trade, because now the stock can do a few different things. It can remain neutral, it can move higher, or it can even move slightly lower, and you would still be in a position to be profitable. So I speak to investors all the time who use this position, position successfully, but you do have to manage it appropriately. You're trying to receive extra income, and in doing so, take on an obligation. When you sell a call, as we know, you are taking on the obligation to sell your shares. So like most options trades, there's a cost and a benefit, and we've talked about the benefits and the risks here. And what you may also give up, if you want to consider it a risk, is the potential for increased upside gain. If the stock rallied sharply, the call you sold would put you in a position where you had to sell those shares, so you wouldn't be able to continue to profit. From a risk perspective on losing on the trade or experiencing losses, it's very similar to owning shares of stock outright. We talked about the lower break-even point and how the premium benefits you that way, but once you go underneath that, you are simply long shares. So to the downside, when you compare the long stock to the covered call side by side, as you keep moving lower in stock price, those graphs look very similar. That break-even point is a little bit better for the covered call, but once you go beyond that, you're simply long shares of stock, and that's where your risk is. So there's an overview of the motivations and the components and the risks and benefits of the covered call position.
Yeah, and Joe, if I can comment here, to really simplify this for people who may be very new to the whole concept of covered calls, this is what I tell my clients. I say, look, there's 3 ways to profit from a stock. We also use exchange-traded funds, ETFs. Look, you either hope that you buy low, sell high. That's called capital appreciation. You may be in a stock that pays dividends. For our clients, we do try to identify stocks with good dividends, those that have consistently raise their dividends over time. But, besides just having capital appreciation and dividends, you also have a third profit source, which is option premium. And like I said, my clients have never used somebody as a financial advisor that talks about the option premium. So it just gives you, as Ed said, it gives you a lot more opportunities to be profitable. That's why I just love this strategy.
And Laurie, go ahead, Alan, please.
I'd like to add a perspective specifically on the market environment that's appropriate for covered call writing. And as Ed pointed out, generally speaking, you're looking for neutral and bullish market environments, but you can actually also craft the strategy to bear market environments if you really understand all 3 aspects of covered call writing, which is stock selection, option selection, and position management. So let me give you a couple of ideas how your listeners can use covered call writing even in bear markets. And the most common way to do it is to sell in-the-money call options. That means that if a stock, for example, is trading at 52 and you sell the $50 call option for $4, that's said to be in the money. Now, if you generated a premium of $4, you cannot count that as profit because you're going to lose $2 on the sale of the stock. So the intrinsic value component, that $2, has to be deducted. So in essence, your profit is then $2, which represents a 4% return. This could be a 1-month contract. Now, that 4% is guaranteed as long as the price of the stock remains above 50. So you have a buffer of $2 and still capture that 4% return. So in essence, the intrinsic value of the premium is protecting the time value, and your break even then becomes $48. So what we have here when we sell an in-the-money strike in a bearish market environment is we have an insurance policy on the time value component of the premium, and this is the interesting part. That insurance policy is paid for not by us, the option sellers, but by the option buyer in the form of intrinsic value. So that's one way you could use the strategy in a bear market environment. A second way is something Laurie alluded to, which is incorporating puts along with covered calls. And the way we could do that, and I refer to this as the PCP strategy in my books and DVDs, put, call, put. Sell an out-of-the-money put, meaning lower than the current market value, and generate a premium that way. An example would be if the stock is trading at 52, we sell the $50 out-of-the-money put for $1.50. Now that means if the put is exercised, we have a cost basis then of $48.50, about 7% lower than the $52 when the trade was entered. So we have that 7% protection. Then if the stock is in fact put to us, we have a cost basis of $48.50. We can then sell an in-the-money call option and generate another 5 to 7% of downside protection. So in this PCP strategy, over the course of 2 months, we're still making money as long as the price of the stock does not decline by more than, let's say, 10 to 12%. And Joe, if I can, let me just give one more example here, because I always get the question about what about in 2008 when the market absolutely collapsed. Well, I'm here to tell you that you could have made a fortune writing covered calls in 2008 if you would have used inverse ETFs. And those are exchange-traded funds that go up when the market benchmark goes down. So you have to be very, very careful with these, because generally speaking, historically, the market goes up. But if I can throw 4 ticker symbols at the audience that they may want to look at if they feel they're in a definite bear market, look at PSQ, which is short the Qs, or the NASDAQ 100, DOG, which is short the Dow 30, SH, which is short the S&P 500, and RWM, which is short the Russell 2000. So if those benchmarks go down, these securities will go up in value, and we could sell covered calls on these securities in strong bear markets and make 2 income streams, one from appreciation of the underlying security and the other from generating covered call premium.
And Alan, I would say new ideas are always a good idea, but I would also caution our listeners that there is really probably a little different level of expertise to get comfortable with those examples that Alan just offered. So all good, but know full well that that's a little bit of a specialty item, I think, if you will. Laurie, I want to ask you about something Alan referred to with regards to selling the puts. Do you do that with your clients? And if you do they understand the whole idea of what the obligations are when we talk about selling puts?
Sure. Selling puts is a great strategy, but when I'm to be realistic, I usually use it mostly in IRAs, because a lot of my clients live here in California. We've got a very high state income tax rate, and a lot of my clients who are working are making a lot of money, and they're in a high income tax bracket. So I tend to, because of the tax treatment of the option premium when you're selling puts, I typically do it mostly in IRAs. Love doing it, and the way I explain it to people, because it's always something that gets people confused. In my book, all the feedback I receive is that they don't understand, are they buying this, they're selling the put, but they might have to buy the stock. I try to just forget the terms, and let's just talk about this. If there's a stock trading at $50 a share, and you like this stock for whatever reason, would you like getting it at a discount? Sure, Laurie. Would you like earning income waiting to get it at a discount? Sure, Laurie. Hey, you may have to end up owning the stock at the price you said you were going to buy it at. How do you feel about that? Okay, understood, Laurie. So we'll probably get into this, that some people seem to be surprised when they sell a put option and they end up having to buy 100 shares of that stock. Well, if you just explain, I think options education is just walking through people every scenario that can happen very calmly. Alan does this very well in his books, very well. So love the strategy, again, mostly in IRAs. It's also really good for some of the volatile ETFs. Like, we have a lot of people who like the biotech industry around where I am in San Diego, and one of the strategies is you can use an ETF like XBI and sell puts, and there's a lot of premium. But we'll talk about why there's premium in some things you might look at and very little premium in others, and it all comes down to risk versus reward.
Okay, and Ed, I don't mean to be leaving you out of this, but I'm going to stick with Laurie and Alan for just a minute here. So, Laurie, you raise a real interesting point. You know, you got biotech stocks when, you know, they come out with an announcement, the world could change tomorrow, so clearly the value of options changes dramatically. I think you're so depending on the levels of premiums, clearly there's going to be a drastically different return. Alan, let me start with you. You know, do you chase returns with covered calls, or is that an absolute no-no? And would you walk us through your approach? And then I'll come back to you, Laurie.
I feel that retail investors who choose an underlying security that generates the highest possible returns is making one of the biggest mistakes they could make if they're using covered call writing. Covered call writing, in essence, is a low-risk strategy, I feel, geared to retail investors. By selecting an underlying security that has a very high implied volatility, that means that the market is anticipating a big price movement in that stock one way or another. It doesn't identify direction. In return for undertaking all that risk, they're going to receive a high premium, but they're also incurring a lot of risk to the downside. So it's very important to determine what your risk tolerance level is and what your goals are. So here's how I do it. I first determine an initial return goal. In my case, it's 2 to 4% a month for my initial returns. In my mom's account, by the way, I trade ETFs where my initial return goals are 1 to 2%, more conservative approach. Now, once I have that return goal down, then I will select an option in the money or out of the money based on my overall market assessment. If I'm bullish on the market, I'll select an out of the money strike, which means higher than the current market value. And if I'm bearish on the market, I'll select an in the money strike, something I alluded to before, where you get that additional downside protection, which is an insurance policy paid for by the option buyer. So if you are bullish on the market, set your goal, whether it's 2 to 4% like my goal is, or higher or lower depending on your risk tolerance, then select in the money or out of the money, and then you're good to go from there. And then your management kicks in from that point moving forward.
And as far as the stocks themselves, Alan, how do you go about that?
The stocks themselves, I tell our members, don't even look at the returns you're going to generate from selling options until you have selected an elite list of stocks or ETFs. And I do it through a three-pronged screening process. Step 1, fundamental analysis, earnings and sales growth. The reason this is so important is because the institutional investors love stocks that have increasing earnings and revenues. And the institutional investors, I'm talking about mutual funds, hedge funds, banks, insurance companies, they're the ones that move the market. So I start out with those elite performers from a fundamental perspective. The second screen is technical analysis. So I use 4 parameters, 1 trend identifying parameter, 2 momentum indicators, and then I confirm with volume. So the price charts or the technical charts have to be bullish. And the third set of parameters I screen are what I call common sense screens. Things like minimum trading volume, asset allocation, avoiding earnings reports, a very, very important rule for covered call writing or selling cash secured puts. We must avoid earnings reports. So I put these stocks and ETFs through these 3 screens, and now I have an elite list of performers from those 3 perspectives, and then I run my calculations and see which options meet my goal of 2 to 4%, and then I select the moneyness from there, in the money or out of the money, based on overall market assessment, personal risk tolerance, and chart technicals. So there's a very specific way of going about it. It may seem a little intimidating initially when you're first learning it, but after a while of doing it over and over again, it becomes very much second nature.
I like that black and white approach. One more question before I go to Laurie. Is it hard to find that 2 to 4% a month?
No, it's not. There are many securities out there when you do your screening that will give you that 2 to 4% a month initial return. Now, the closer to at the money you go, the higher the return. So in months when I'm a little more concerned about the market, I might settle for the 2% and stay away from the 4%, and in a more bullish environment, go closer to the 4%. But the only times of the year when it's a little bit challenging to find that 2 to 4% is during earnings season, because as I said before, I never ever sell a covered call or cash secured put if there's an upcoming earnings report before contract expiration. So in the heart of earnings season, a lot of the securities will be reporting. So what I do in cases like that is I use the eligible ones that are not reporting plus ETFs, and then each week during that contract month, certain stocks will fall off because they will have reported, and then I can add those stocks to my database of eligible stocks and still get 3 to 4 weeks of time value premium on those. Otherwise, aside from the earnings season, it's never a challenge.
Okay, excellent. Now, Laurie, do you have a similar process, like Alan, in going about, picking stocks, picking strikes? Can you elaborate?
Sure. I agree with a lot of what he said, but I have a totally different approach because remember, I'm managing lots of different portfolios, so my number one objective is to make sure that any strategy I employ is going to be compatible with what their investment objective is. Some people may have a growth objective, people might have a growth in income, some people might have an income objective. So if somebody is saying to me, I have an income objective, it's saying, I'm not really counting on capital appreciation of the stock, okay? If bonds were paying 8%, I'd probably be in bonds. So as Alan talks about this whole in-the-money strike selection and choosing stocks that may have a lower beta, lower risk, so already that's why the whole strategy of covered calls is incredibly adaptable to whatever investment objective the client has. What's also important is realizing that the whole portfolio isn't entirely covered calls. The beauty of all these ETFs that are out there that are low fee, and even Schwab and TD Ameritrade have a bunch of low fee commission-free ETFs, if that's important to people trying to look at, hold down their commission charges, is that we want to get a well-diversified portfolio. That means there's going to have U.S. equity exposure, some developing country perhaps, developed countries. We may want some commodity exposure, may want some real estate exposure. And so the way I look at a portfolio is I look at what can I accomplish using ETFs, some of which may have options available on them that are high volume liquid because you don't want to have a huge bid-ask spread. And then where I really like to use the options is in a lot of the U.S. stocks where I really know those stocks. And there's, again, we gravitate to the kinds of companies that have, even in bad times, even in the 2008, have paid their dividends or have raised their dividends. Because at the end of the day, we're going to have bear markets from time to time. And yeah, it stinks seeing, the value of your portfolio fall when the stocks and the underlyings are falling, but at least you're getting paid that income. And then again, with covered calls, you got to manage it properly because you don't want to lock in a loss, but there's a way to generate income even when times are tough. So that's really my approach to the portfolio management.
Okay, fantastic. And honestly, that's why I love to be involved with the panels, because we get, real-life practitioners telling us how they go about their business. So thank you both. Ed, I want to bring you back into this. Let's get back to the educational side. And, I think some of the terms, if folks are new to options, maybe a little bit beyond them. So I want to go back to, we're talking covered calls and we're selling puts. Would you, define for our listeners any difference? If there is any, or if there's a similarity, the covered call versus selling the put?
Well, the position of being long stock and short a call versus short a put at that same strike price is identical. Really, a lot of investors look at selling a put as a substitute for the covered call, and they're able to accomplish that with one trade instead of two. So when you sell a put, you are putting yourself under the obligation to potentially have to buy shares at that strike price, and you receive premium, the option premium, into your account immediately upon sale of that option. And that's non-refundable. That's in your account and doesn't go anywhere. If you do reach a point where you are assigned and you need to buy shares, then as Laurie pointed out earlier, you're buying those shares at the strike price. You've already received the option premium, so your break-even point or your cost basis on the trade would be your strike price minus the option premium. This is a popular trade to use when you're looking to enter a position. Again, this is consistent with Laurie's example. If the stock's trading at a certain level and you're interested in getting into the stock a little bit below where it's trading today, you can sell a put option, receive premium. If the stock stays neutral or even rallies a little bit, that premium is yours. If the stock does sell off and go through your strike price, and you're assigned on that option, then you'll be in a position to buy shares. You'll be required to buy shares. Your break-even point would be your strike price minus the option premium. Now, one thing that might be misunderstood, and when I talk to some newer traders and investors on the investor services desk, some of them treat selling a put like a limit order, and it's similar, but there is an important difference. When you enter a limit order in on a stock, if that stock price trades through your limit order price, you'll get filled and you'll buy shares. Investors in options, especially newer to options, might think that if the stock trades through their strike price on the downside, they're going to get assigned on their put option and they're going to have to buy shares. And that's really not true if there's time left in the option. If you think about things from the buyer's perspective, the buyer would need incentive or motivation to exercise their option early rather than just hold it until expiration day. And frequently what you'll see is that in order to get assigned on a put option, the stock needs to be trading below the strike price at expiration day. The reason why I'm describing this as a limitation is because, of course, the stock can go down through your strike price, then turn around and start heading higher. If you had a limit order in on the stock, you'd be long those shares and you'd capitalize on a move higher. If you sold a put, you may have never been assigned, don't own shares, and not participate in that move higher. Of course, you'd still profit on the option premium, but that's a limitation. Now, if you're a put seller, you know that limitation going in. You're comfortable with it, and you're willing to take that limitation because you're getting paid the premium. That's in your account right up front, and you have more ways to be profitable here. Again, if the stock stays neutral and you sold an out-of-the-money put, it expires worthless, you profit the option premium. The stock rallies, same thing would happen. As your option expires, you can continue to sell puts over and over again and routinely profit off the option premium. And then, of course, if the stock does sell off and you're assigned, you're entering into a position at a level that you're comfortable with, and the cost basis being somewhat lower than your strike price. So that's selling puts in a nutshell.
And so the risk profile for both is exactly the same thing.
Yeah, if you were to create a P&L chart, and that's something that when I learned how to trade options, that was one of the things that the trading firms I worked for encouraged us to do, and I'd encourage anyone else to do who's learning options. If you could create a P&L profile of a trade, selecting different prices in the stock and calculating what your profit and loss would be at expiration, and you compared the covered call to selling a put, you'd see the graphs look exactly the same. The risk and reward is exactly the same, and that's why I said some investors will sell puts instead of doing covered calls because they get the same risk-reward profile, and they accomplish that with one trade and one commission.
Okay, very good, Ed. Appreciate that. Does anybody have anything they want to add regarding, risk associated with either the covered call or the selling put?
I'll just emphasize that absolutely what Alan said, that you cannot be driven by the premium. You have to be comfortable with the underlying, whether that's a stock or an ETF, and you need to have an exit strategy before you make the trade, because risk is really determined, how much risk you take is really determined by how you manage that risk, really. And again, options give you so much flexibility in terms of the strike price you use, the time frame you use in terms of how far away expiration is. You can do a variety. I mean, let's say you have, you're going to write 10 contracts. Sometimes what we do is we may, write different strike prices at different expirations. I know that I have clients that have come to me because they have concentrated stock positions. Maybe they've left the company and they had a lot of stock. And so we'll write calls at different strike prices, different expirations, and constantly moving and managing it based on how the client is feeling about the risk tolerance at the time.
And Laurie or Alan, do you have a particular recipe for the time frame that you like to sell? Alan, I'll go to you first.
Can you hear me okay?
I can.
Okay, yeah, the battery on my phone went, so I picked up another phone. Yes, time frame. 1 month. That's my sweet spot. 1 month option for several reasons. The most important reason is something I alluded to before, which is to always avoid earnings reports. So earnings reports come up every 3 months. So by taking only a 1 month obligation, what we're doing here is we're allowing ourselves to circumnavigate around these earnings reports. So in essence, I'm never in a position for more than 2 months at a time unless it's an ETF because of earnings reports. Now, if a particular security has weeklies also, what you could do is you could sell weeklies up to the week of the earnings report, skip that 1 week, and then jump back in the week after that. So that's one reason I like monthlies. The second reason is that monthlies will give you greater annualized returns than longer-term options. Check any options chain and annualize 1 month versus 3 month versus 6 month versus leaps, and you'll see the annualized returns on the monthlies are always greater. And finally, by using monthlies as opposed to longer-term options, you're having an opportunity to reevaluate that particular stock, whether or not it should be in your portfolio. I mean, you enter a position because for fundamental reasons, for technical reasons, for common sense reasons, or for whatever screening process you're using. And those may exist in January, but they may not exist in March or April. So it gives you an opportunity to reevaluate the securities within your portfolio and the opportunity to move some out and better securities in later on. So by far and away, monthlies is my sweet spot, although we do have a lot of members of the blue-collar investor that like to write weeklies also.
Okay, and for you listeners who may not be familiar with the weeklies, as I mentioned at the outset, we've got a little over 4,200 stock indexes and ETFs. Currently, there are about 600, just a little over 600 products that have weeklies listed, and so you can literally buy and sell an option that starts on a Thursday and expires the following Friday on about 600 issues. Laurie, do you have any sweet spot for time, or does you take it per client?
Absolutely. So I am a math geek, and what Alan has said in terms of optimizing this, a monthly is usually the best way to go in most cases, sometimes weekly. But again, for me, managing all these portfolios, and I have to be competitive with other financial advisors, my AUM, my assets under management fee, needs to be competitive, and I simply cannot be trading options customized with every different portfolio with 1 month expirations. So mine, and also, we trade through Schwab, and my clients get the trade confirmations every time. So they figure their inbox is getting deluged. So typically, if it's a large account, I'm looking at usually 2 to 3 month expiration. Sometimes it's a very small account and we're just not doing much trading. I've even used options that expire up to 6 months. But recognizing that from the math purist standpoint, the shorter term is likely better, and also what Alan says in terms of volatility with earnings season. So if you're going to do it yourself and you have a good portfolio to work with, I definitely do encourage the use of at least starting from the frame point from the monthly. But what's also good is what I do is when I'm teaching people, we always use the monthly as a start point because that's a good way to look at computing your annualized rates of return. Again, you can't really extrapolate a monthly return into an annual return. There's many reasons why you can't do that, but it gives you the ability to compare what the return would be 1 month versus a 2 month or 3 month. And because of the logarithmic nature of options, again, the 1 month is ideal in most cases.
And let me go back to you, Laurie and Alan, with regards to when you explain this strategy to investors. You know, does it click quickly? Like that? Wow, this makes a lot of sense, and embrace it, or is it a hard sell, Alan?
It's not a hard sell. First off, there are two components to covered call writing. There's buying and selling stock, which pretty much everybody is already familiar with. So really you have to deal with the second leg of it, which is selling the option. And initially when you give, I always give a hypothetical example to start with. And once you give that hypothetical, then it becomes somewhat intuitive. And by the way, I think one of the reasons why just about across the board with every broker, covered call writing is permitted in self-directed IRA accounts is because our government and these brokers feel that covered call writing is intuitive for retail investors. They kind of understand and get it. Now, the initial reaction is yes, but of course they're not ready to go just by having a basic understanding of the strategy. You have to be able to master all three aspects. As I said, what stocks, what underlying securities are you going to use? I use individual stocks in my personal portfolios. I use ETFs in my mom's, so one size doesn't fit all. And so once you have the stock selection, you get into which option, and you have to base that on several factors as well that I alluded to before. And something that we haven't talked about and is critical, I can't say it enough. It's absolutely essential that any of your listeners out there that are going to use these strategies must understand position management or the use of exit strategies. And so what do you do if the price of the stock goes way down? What do you do if the price of the stock goes to the moon? What do you do if there's an ex-dividend date before expiration? What do you do if the strike is in the money near expiration and you don't want your shares sold? So you have to be prepared with every possible scenario that can come up. It isn't rocket science. I tell people when I do my seminars all the time, I'm not any smarter than you are. I've just been doing this longer. And so once you've mastered those three aspects, so to get back to your question, Joe, yes, it is understood up front from a very basic general vantage point, but not enough to get going. It takes 3 to 4 months to really master all three aspects of these strategies.
Okay, and Laurie, I'll come back to you in a sec, but Ed, I want to ask you, because Alan touched on something that is so important, this whole idea of exit strategies. Can you speak to some of the tools we have at Options Edge that can help investors, understand what the risks are in a covered call or selling a put?
Yeah, we've got a lot of tools and a lot of information specifically on the covered call, but with a lot of strategies. There's a section on our website that's called Strategies, and you can filter for different option spreads with different market outlooks and view a very detailed description of what the covered call is all about and the cash secured put, but also we have a very detailed specific covered call calculator where you can put in stock symbol and stock price, option price, and days to expiration, and test out a few trades and see what kind of returns you get. We also have a virtual trading system which can actually allow you to practice entering orders and managing a position. It uses delayed market quotes, but realistic quotes with live symbols. So optionseducation.org is the website. That's for the Options Industry Council, and there's many tools there that you can use to your advantage to learn these spreads.
Thank you, Ed. And Laurie, your experience, you said earlier a couple times, I think, clients who come to you have never used options. So what do you find to be their reaction? Obviously, they're coming to you for that reason, or that's one of the reasons. How do you find the process of them understanding and actually implementing these strategies you suggest?
It's just been amazing, such a variety. I mean, the people that get it right away understand how much work is involved in effectively managing it, and that's why they hire me. They like the strategy, but they don't want to do the work themselves. They'd rather pay somebody, you know, 1% or 1.5% to do it. The people, I do have to say that one anecdote, because we're going to get to it later anyway, but one anecdote is we were almost fired by a woman whose Apple stock got called away in a covered call. And that is always, you know, people always, they just don't understand, well, what do you mean? You mean I might have to sell the stock? But these are the same people who have never put targets on their stock, target sales prices. So I think if you're a stock trader and you're coming with that background and you've thought about when should I sell, you know, I made 10% on this position or 20% on this position, people that have already been effective managing a stock portfolio are going to be the same people who are effective managing a stock portfolio with an options overlay. In terms of the people that I coach, I have been shocked. The people who I thought would get it the fastest, the math people, the engineers, often they do, but I've also had teachers and artists and psychologists get it. So don't, as Alan said, it's not something that you need, you know, you don't need a PhD in rocket science to master this. You just need an analytical mind, patience, and discipline.
Yeah, Joe, I want to add something here. I'm not sure if this has been clear to our listeners. A couple of times we alluded to the fact that shares of stock were sold and the share owner may not have wanted them sold. As a covered call writer, your shares do not have to be sold. You can institute an exit strategy to prevent your shares being sold, I'm going to say more than 99% of the time. Because exercise of the option, we know when that's going to happen almost all the time. And that is after 4 p.m. on the third Friday of the month. That's Eastern time. So if we know when those shares are going to be exercised, if the option is in the money or lower than the current market value, we can simply buy back that option. We buy back the option and our shares will not be sold. Now, the only exception to this is when there is a dividend distribution taking place prior to contract expiration. In those cases, the option buyer may want to exercise the option, buy our shares from us to capture that dividend. And there are several tactics that you can use to even avoid that from taking place. So once you've mastered this third skill of position management, I want to make sure that all the listeners out there understand your shares, our shares, do not have to be sold. We could take action to avoid that.
Alan,
but in some cases, it is preferable to have it sold rather than buying the option back. You know, I just want to make sure that people understand it. What you said is absolutely right, but there are consequences in doing so and trade-offs. You know, there's no free lunch.
Certainly no free lunch, but I think as Alan suggests, you know, and not necessarily aggressive, just forward-thinking exit strategies allow you to avoid being called away if you are managing your position in advance. And you know, I think, Alan, you used the term 99%. I'd agree with you. Investors almost always know when their option's going to be called away. So
yeah, if I could chime
Please,
in on
Ed.
this concept as well. Yeah, it's a frequent question that comes across our desk at Investor Services from investors who have this position on, and they call us asking, what do I do now? My option is deep in the money. and they aren't sure how to exit. Well, by that point, it might be too late for them to do something favorable, but this idea that's been mentioned by everybody about position management and staying on top of your position and making sure you're monitoring your account and managing it appropriately is very important, because at some point, if you don't want to have your stock get called away and the call goes too far in the money, it may be difficult to manage the position appropriately.
Good point, Ed. Let's see. We got almost 10 minutes left. There are some misconceptions out there that are associated with covered calls. Laurie, you want to take this first one here? That being assigned is bad?
Yeah, so this can happen. We've talked about stock getting called away, and in terms of being short a put, you may end up buying the stock. This isn't bad at all. If you have a plan, again, what was your initial goal? That is highlighted, and we walk through the scenarios. If you sell a put option, you need to be ready and willing to accept delivery of those shares at the strike price you chose. It is in your power to choose the strike price. It is in your power to choose the expiration. And, you've just got to go into this with the mindset of these are the scenarios and this is the optimal outcome. And if I don't get the optimal outcome, how can I manage for plan B?
And so plan B, go ahead, Laurie.
No, I just mean, but, others can extrapolate on this. I mean, I'd love to hear, Alan, you get comments, you get people writing in about this all the time as well.
Assignment, like I said before, can be avoided 99% of the time. So it's really almost a non-issue that assignment is bad. If assignment happens, it's because you allowed it to happen. So, it's really on the covered call writer. You simply have to understand how to institute these position management trade executions, and you can avoid assignment. And 99% easily. I mean, I've been doing this for over 2 decades now, and I've been assigned unexpectedly maybe 3 or 4 times, and I write a huge amount of contracts every month. So it's really a non-issue, and definitely misconception or myth is a good way to describe it.
And for our listeners out there, of the 17 million or so contracts, 17 million contracts that trade each day, statistics that come from the OCC are that about 75% of those trades are closed before expiration. So, people are getting in and out of these things on a regular basis.
Right, and that's what we won't talk about it on this segment, but I mean, rolling your options, that's obviously a whole other subject, and that's one of the tools you can use when you encounter the situation is rolling out to a different strike price or a different expiration or both.
Exactly, Laurie, and that's funny because at OIC this year, each month, we pick an educational topic. Obviously, today's income generation. But the month of May, none other than rolling, will be our topic for the month. So thanks for that unexpected promo there. Let's see, misconception 2, covered writing is good because most options expire out of the money or worthless. Ed, you want to just speak to that briefly?
Yeah, as you touched on here, Joe, most options trades, the majority of options trades that are opened up as long positions are closed out in the marketplace. And I think a couple of statistics maybe have gotten confused with each other. This number has been floated around in different forms saying that most options expire worthless. And the fact is that of the options that are open long and held through expiration, a majority of those do expire worthless, but that by no means is the majority of options that are open. As Joe pointed out, about 3/4 of all open positions that exist from options investors are closed out before they ever reach expiration. So by no means does that mean that most options expire worthless. Therefore, writing options is always a good idea, and you should write covered calls simply because they're probably going to be worthless. It's not true at all. It's a myth, and as the bullet points show you, the motivations for doing the covered call really boil down to your market outlook, the idea that you want to generate more income, lower your break-even point to give you more possibility probabilities to be profitable in either a bullish outlook to the moderate side, a neutral market, or even slightly bearish by having that slightly lower break-even point. So those are your motivations, not because most options expire worthless.
Excellent, Ed. Number 3, covered writing forces you to sell winners and keep losers. Maybe Ed, you want to give that a shot as well?
Yeah, this boils down to position management. We've talked about it a lot today, all of us, for good reason. By no means does covered writing force you to sell winners and keep losers. If you are managing the position appropriately to the downside, you know what your risk is. So if you own shares of stock, you are managing that appropriately. You're getting out at the appropriate times, maybe setting stop losses, managing the position within your tolerance for risk. Well, a covered call wouldn't be different. As you start to experience losses, you may have to exit a position. Now, one thing to keep in mind when it comes to exiting the covered call is that you very well may be in a position where you have to exit the stock and the call at the same time, or at the very least exit the call first. I bring this up because a lot of options investors don't have permission to be short a naked call option, and if you have a market sell-off or a market crash and people panic and they don't have their head on straight and they go into just simply sell shares of stock that's losing money by the second, they may get rejected orders. So just as a side note to point out, when you have a covered call position, it's very possible that those two sides, the stock and the call, are tied together, and when you need to exit the stock position, you may also need to exit that call option at the same time or before. But the point is active management and knowing your risk, knowing your tolerance, and exiting when appropriate.
Okay, I'm going to leave number 4 for you, Alan. The fact that, and we touched on this earlier, the larger the premium, the better. I think you had some strong words about that already.
Very, very strong words, because it's one of the biggest mistakes made by retail investors relating to covered call writing. High premiums mean high implied volatility of the underlying security. That equals high risk. This is a low-risk strategy. We're looking to hit singles and doubles. We're not looking to hit a grand slam home run. And so if we stay within the framework of reasonable expectations for our monthly returns, we're going to stay out of trouble. So let me give you a quick example, Joe, of how I learned this lesson the hard way back in the 1990s.
Was it your portfolio or your mom's?
No, this is mine, and
okay.
This is before I was managing my mom's. Back in the 1990s, there's a company called Taser. They make these stun guns, and they were doing various tests in police precincts around the country, testing the efficacy of these stun guns. And one report would come in favorable, and boom, the price of the stock would go high. Then another report would come in negative, and boom, the price of the stock would go down. As a result, the security itself had a lot of implied volatility. It was whipsawing up and down, and the premiums were returning about 8 to 9% every month. And when I took a look at this, my eyeballs almost popped out of my head. I said, I got to get some Taser. So I went out and bought way, way too much Taser. I'm embarrassed to say how much. And I started selling monthly call options on Taser. And yes, I was generating these great monthly premiums as I watched Taser go from $36 down to $6 a share. So the moral of the story is that I bought Taser and used it in my covered call portfolio for all the wrong reasons. I didn't fundamentally screen. I didn't technically screen. I didn't put it through the common sense screens. I bought it for one reason and one reason only, and that's greed. And greed should not be a part of our equation in our portfolios. It should definitely not be. So what we do is we set a goal based on a very reasonable expectation, minus 2 to 4% a month. That will keep you out of trouble, because if you're going to get a much, much higher return, that means there's a lot of risk in the underlying security. You don't even have to look up what the implied volatility is. It's in the premium. You could tell from what that monthly near-the-money strike gives you whether or not there's a lot of high implied volatility in the underlying security. And so from there, you go in the money or out of the money.
Painful example, but thanks for sharing, Alan. And we've already gone a couple minutes over. Ed, we're going to have to come back to the credit spreads another time, but I want to give each of you just an opportunity I think it's been an insightful conversation. The hour's flown by, but I want to give each an opportunity to just say a few last words. And Laurie, ladies first, I'd like to start with you.
Great, thanks. Well, I just want to thank everybody and for OIC for hosting this, and thank you, Alan and Ed. Look, covered calls are a phenomenal strategy. I think every investor should be exposed to this, learn about it. Whether or not you utilize it is up to you, but it's simply, if we look at tennis, there's the forehand, cross-court lob, volley. This is a basic investing tool, and I'm doing my part to make sure, I wrote a book for appropriate for beginning investors and experienced investors, marketed towards women. Every woman should know her options. And I introduced these strategies because they are not risky. They are less risky than simply just buying stocks. I feel very strongly about that, especially if you manage these effectively. I welcome comments, questions. You can always find me at theoptionslady.com. theoptionslady.com. Would love to hear from folks, and thanks again.
Thanks for joining us, Laurie. Alan, closing thoughts?
Joe, thanks to you and the OIC for inviting me, and I'm honored to be part of a panel with such experts like Joe and Ed and Laurie, and thanks to everybody for attending. A couple of takeaways here. Number one, you must start out with a plan, and that plan must start out with education. That is number one. You cannot jump into covered call writing because you have a very general, basic idea of the strategy. And the education should be 3 required skills. You must master all of them: stock selection, option selection, and position management. Once you've educated yourself, there's another step you need to do before you actually execute your first real trade, and that's paper trading. And that means practice trading on some kind of platform that your broker may have, or I believe the CBOE or OIC sites have paper trade platforms where you can actually practice. An analogy I use in my seminars is that you're not going to read a book about swimming and then jump in the Pacific Ocean. You're going to dip your toe in the shallow end of the pool first. So you must practice. Once you've practiced, the 2 things I want you to avoid, the 2 biggest mistakes that I see retail investors making, and I'm just going to repeat in conclusion, do not start too soon. Take your time. It'll take about 3 to 4 months to master this strategy if you start off knowing very little or nothing at all. And number 2, do not get enticed by high option premiums. Stay within a reasonable monthly return, and that way you'll stay out of trouble.
Thanks, Alan. And Ed, would you, take us home here before we give it back to Nick?
Absolutely, and I'd like to also thank Joe and Nick for inviting me here, and it was a pleasure to be along with the panel. Alan and Laurie, hearing your expertise was an enjoyment on my part to be a part of this presentation. Speaking from an educational perspective, when I present seminars, one analogy that I give for those trading stocks, we're thinking about options, I like to say that trading stocks is comparable to playing a game of checkers. It's very straightforward, very simple. You can teach a 6th grader how to do it, whereas trading options is like playing a game of chess. It takes time and dedication. You have to commit yourself, spend time educating yourself, and if you can play a good game of chess, it can be a lot more rewarding. It's a lot more difficult, but a lot more rewarding. So the words of encouragement to our audience, especially those just starting out with their education, is that options can be daunting. They are complicated, but they're not difficult to understand. If you commit yourself and you study and you participate in events like we're doing here today, it can really help you out. And in no time, you'll see the light bulbs go off in your head, and you'll start to understand these concepts. Alan just mentioned practice trading. We have the virtual trading system on the OIC website at optionseducation.org. It's a great tool. I encourage you to utilize our VTS system and dedicate yourself. Learn about options, and hopefully they can help you enhance the returns in your portfolio.
Thanks, Ed, and thank you, panel. I'm lucky to be able to be part of these panel discussions. I really enjoy it. So, Nick, hopefully our listeners are still with us. Hopefully they filled out some surveys, and I will turn it back to you.
Thank you, Joe, and thank you to our panelists today. And ladies and gentlemen, thank you for attending. We did have quite a few questions come through from our listeners today, and our panel was unable to get to those due to time restraints. But if you didn't get to hear what you wanted to hear from our experts today, we do have our investor services team, of which Ed Modla is a member, and they are ready to help. Feel free to reach out to them at options@theocc.com. As I mentioned, today's session will be archived and accessible in a few hours using that link that you used to join us today. Additionally, our webinars are on the OIC YouTube channel, so you can review a number of options, strategies, and concepts at your own pace. Many of you in your questions also asked about further education. Please visit optionseducation.org, the OIC's website, and see the Getting Started section for further reading. And, of course, make sure to check optionseducation.org in the upcoming weeks for our next online sessions. Our next two webinars will be held on May 17th and May 24th, and then following that, we'll be having a full-day webinar summit on June 21st. You don't want to miss those. Ladies and gentlemen, thank you again for attending, and we hope to see you next time.
Investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of the Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions@theoptionsinsider.com.